And today we're going to look at the budget and how it could affect your investments going forward. And this is basically my summary. To put the budget strategy into a nutshell, there's going to be a budget deficit of $213 billion. Now that's 11% of GDP. This is expected to lead to economic growth of 4.25% in 2021 after we contracted by 3.75% in 2020. That's nearly an 8% turnaround in growth. But this, via tax cuts and business tax relief, totaling $50 billion plus wage subsidies of $4 billion will lead to higher consumption, higher business investment, plenty of job creation and ultimately economic growth. That's what the Treasurer wants.
Well, let's look at some of the specifics, Peter, because that's a good lead in. You mentioned the deficit of $213 billion. Look, falling to $70 billion by 23-24. About $480 billion over 4 years, so they're pretty big numbers.
Big numbers.
An even bigger number is net debt, $703 billion this year, peaking at just under $1 trillion in 2024. Budget didn't talk about the gross debt number, but it's about $1.7 trillion, I think.
Yeah, but Paul, what's also interesting is it's still smaller than the post-World War II budget deficit, and we're still one of the, I think we're the lowest OECD country in terms of our gross debt.
Yep, we are indeed. Gross domestic product or growth, Peter, you said for 21-22, 4.75%. That's a financial year, down to 2.75 in 22-23. Unemployment, they say, will peak this year, Peter, in December, falling to 6.5% by June in 2022.
Much better than was expected.
No taxation increases, massive spending on jobs, infrastructure, lots of business incentives we'll get to. But importantly, they are really assuming that the worst of COVID-19 is behind us. So, look, that means that the borders do open at some stage in 2021. A vaccine shows up. So if there was another setback in regards to the pandemic, this budget ain't going to stack up.
That's right. And more spending will be required. Okay, let's go and look at the measures in more detail for sectors and ultimately companies.
Yeah, lots of stuff on jobs. So a job maker program, a wage subsidy for apprentices. Perhaps the two biggest announcements were the instant asset write-off and the lost carryback. The instant asset write-off we've seen before, Peter. It's usually been accessed by small businesses. Now businesses are up to $5 billion in turnover. That's about 99% of all businesses will be able to access it.
Yeah.
That means they get an instant deduction for any piece of equipment they buy. There's no limit. We'll also include improvements to some existing assets, and that'll last till the June 2022. So a lot of businesses will be able to use that, providing they're paying tax. That's the only and very important caveat to that. The lost carryback, there was a bit of talk about this beforehand, but I think this is actually going to help a lot of small and middle-sized companies, particularly those that were making money and are now doing it tough as a result of COVID-19. Because the way it's going to work is if a company's paid tax in 2018-19 and 19-20, that's the financial years we've
a lot of hospitality businesses.
Like a lot of hospitality business, the years we've just completed. And now they incur losses in this year and also the next tax year. They'll be able to get a refund of back from the tax office to offset the loss.
Yeah.
So there will be some companies listed on the ASX will have an immediate cash impact that they weren't expecting.
You would think companies like Webjet and Flight Centre, all those sort of companies.
Well, there is a turnover limit of $5 billion,
yeah.
so I'll have to check that out, Peter. But there'll be mainly some small caps that'll apply to. The tax cut for individuals, these are the stage 2 tax cuts brought forward to the 1st of July 2020. That's already happened. So the date's already passed us. So that means that the tax cut will benefit something like 11 million Australians, cost $17.8 billion. And it means because it really, when it starts to hit wages later in November, the end of October, they'll actually get sort of 2/3 of the amount, or it'll actually get a double boost because
it's a bigger bang for the tax.
It'll be applied back for the 1st of July, so there'll be bigger tax cuts for those periods from November through to June. That'll have a big impact on spending. Another round of the first home buyers program, that's 10,000 further loans on low deposits, responsible lending changes that were flagged beforehand. A lot of spending on infrastructure with also some spending on a take it or lose it basis with the states really to get them to sort of get their act together. And of course the manufacturing strategy sees prioritisation of 6 sectors.
And notice to have a look at the companies that could be winners, Paul.
Well, really 2 groups. One is the discretionary retailers. They're the JB Hi-Fis, Harvey Normans, the Kogans.
Yep.
That money that's going in through tax cuts is going to find a home somewhere, Wesfarmers as well, but also the extension of the instant asset write-off. That means more things like computers and equipment that companies will buy. So that should be really good for those companies that are actually, or our retailers that are actually going to see the money coming out of both individuals and the business wallet.
Yep.
Banks and payment companies will also do well, not only through things like responsible lending, Peter, but all this money and all these new job hiring programs, that's going to put off, and maybe take away any of the pain that we might have had, and not all the pain, but some of the pain around, bad debts.
Yeah,
because that money's got to go back into the community. Wallets are going to be bigger, and that means more spending.
And that's where the payment companies
And that's
will
where
do
banks come in, it's where payment companies. So they're winners. Obviously, builders, construction companies. That's steel for all the infrastructure companies like BlueScope, Boral, Adbri, and others. I mentioned about the small and mid caps can win from the instant asset write-off. That could be good for even some miners there, but the loss carry back. There will be companies that will immediately be able to say, we'll be X million dollars better off as a result of that.
And the tax
program.
office is becoming a funder of business.
It is becoming a funder of business. There's a program about recycling and waste, so banning of plastics, and also some money to help recycling. And also a lot of money being spent on digital innovation. That'll help some of our tech companies.
And startups for sure. Now, for losers, I've said before, this is a budget, it is all about giving, but there are a couple of losers, Paul.
Well, yeah, I almost could not find a loser, Peter. I mean, I think every company that's involved in the Australian economy is potentially a winner from this. But there are some further superannuation reforms about naming and shaming, and also encouraging a non-competitive or funds that aren't performing very well. Plus also some moves to actually really make, cut down the number of super accounts. So our wealth managers and AMP and IOOF, they're potentially losers. Also a company like Link, because of the number of accounts. Anyone involved in superannuation who's trying to profit out of actually the activities, providing a service to it, they could be impacted. So there's some losers.
Because the Treasurer was talking about the superannuation will follow you wherever you go, as opposed to having a whole pile of different superannuation
Look,
accounts.
long overdue reforms. The Treasurer was picking up just how much money is spent in superannuation fees. And, it is an industry that has been fat and has needed some government action.
Okay, so to sum up, if the assumption of the budget proves to be correct and we see 4.25% economic growth next year as predicted, this must carry through to the revenue and profits of our major domestic focused listed companies. And that is really good news for share prices going forward, and we might even see gradual improvements in those outlooks for dividends as well.